What's up, everybody? Welcome to Heresy Financial. My name is Joe Brown, and today we are looking at whether or not people or investors should be concerned about a real estate crash, specifically residential housing, single family homes, duplexes, triplexes, fourplexes. We're going to be looking at whether we should be worried about a crash coming in real estate anytime soon or not, whether this is despite the recent drastic increase in prices, we should expect that this trend will continue. We're going to be looking at the real data to make an educated decision, number one, and then number two, we're also going to be looking at some of the arguments for a real estate crash and weighing them against the data to see if they hold any merit. And as a bonus at the end, I'm going to share with you my top 2 favorite ways that I like to invest in real estate right now. Ready? Let's dive in. Understandably, many people are very concerned about a real estate crash specifically because of a couple of main factors. Number one, we've got a ton of people in mortgage forbearance right now, and it is unknown how many of those may or likely will turn into foreclosures and or evictions. We're also seeing a run-up in interest rates, specifically mortgage rates, which is leading to a collapse in mortgage applications. Further than that, we've seen an absolutely historic rise in prices, largely due to a supply of new houses hitting the market, a supply shortage, an inventory shortage. And so by some accounts, it is very easy to see how you could have one or two events catalyze the rest of these things turning around. Let's say we have an eviction crisis. Let's say we have a foreclosure crisis where most people who are in forbearance, all of a sudden when that ends, they have to foreclose. Banks take the homes back. All of this new inventory hits the market. Prices start to collapse, accelerated by interest rates continuing to go up, making mortgages more expensive, which means that homes are more unaffordable. So it's very easy to see how the argument can be made for a downward spiral in home prices that were basically at a peak, at a top of a bubble here. So let's look at each of those individually to see whether they are big concerns or not. First, let's take a look at interest rates, because we know that the average price of housing across America has about a 10 to 1 relationship to interest rates. So for instance, what I mean by that, if interest rates go if mortgage rates go from 3% to 4%, all else being equal, you would expect to see average housing prices drop by 10%. So a $500,000 house would go to $450,000. And the main reason for that is simply due to just, again, all else being equal, the affordability of that home. Your payment would be about the same in that case for your average fixed rate 30-year mortgage. A mortgage for $500,000 at 3%, at a 3% interest rate is about a $2,100 payment versus a $450,000 mortgage at 4% is about $2,150. So pretty close. Now you might be thinking, wait, I thought mortgage rates have been going up for the last couple of months. And if you're thinking that, you'd be right. If we take a look here at the recent price movement of the 30-year mortgage, we can see that it bottomed at 2.65% in January, and it is currently sitting just under 3.2%. Despite this, home prices have been rallying like crazy. So you might be thinking, well, I thought you just said that if interest rates go up, that is a downward pressure on home prices. That's true. That means if interest rates had stayed lower, home prices would be rising even more fast, because I said it's all else being equal. Interest rates are by far not the only thing that impacts real estate prices. It is a factor, and if mortgage rates were to go to 4%, 4.5%, 5%, 6%, that would definitely be putting heavy downward pressure on home prices. However, mortgage rates are heavily dependent on what the Federal Reserve does. They're heavily dependent on how many mortgage-backed securities the Federal Reserve buys. They're heavily dependent on interest rates of the treasuries that the United States government issues, which are purchased by the Federal Reserve in order to keep rates at a sustainable level. Right now, the Federal Reserve is committed to buying at least $120 billion per month of both treasuries and mortgage-backed securities, meaning that if interest rates get too high, they can increase the amount of purchases, which, by the way, they haven't been purchasing their minimum minimum of 120. They've been purchasing more than that. And so theoretically, in an isolated experiment, yes, interest rates could go up enough in order to put downward pressure on home prices. But despite the recent rise in interest rates for mortgages, it has not had any negative impact on home prices. We're continuing to see record growth across the nation. And if interest rates get too high, the Federal Reserve will have to step in and push them back down by buying up even more debt, because the government itself cannot afford higher interest rates. If the government's interest rates on its debt gets too high, they won't be able to afford to take out new debt to pay off their old debt, which means they're insolvent. And so the Federal Reserve has to keep interest rates at a low enough level to keep the federal government's budget rolling. And like I said, we've continued to experience record growth in real estate across the country despite the recent rise in interest rates. In fact, in February, the median existing home sale price rose to $313,000, which is almost 16% higher than 1 year ago. And that's across the country. And when you break it down by region, every single region had double-digit growth. And so remember what I said about interest rates and home prices being inversely correlated at like a 1 to 10 ratio. So let's say interest rates go from 3 to 4%. That would theoretically push housing prices down on average 10%, but we're having 10%, 15% growth despite that. That means if interest rates had stayed low, the growth would be higher, but we would need those interest rates to come up 1 or 2% to even flatline the growth, let alone start pushing prices back down. Again, like I said, all else being equal. And it's very, very unlikely that the Federal Reserve can allow interest rates to get that high simply due to the federal government's budget needs. Now, if interest rates, like I said, are not the only factor contributing to home prices, then what are some of the other factors? Well, I mentioned supply and demand, right? Inventory is at a historic low because every time a home comes up for sale, it gets snatched up within days, especially in isolated areas around the country. You're seeing bidding wars take place. You're seeing appraisal contingencies getting dropped, which means there's, let's say, 10 people trying to buy the same house. You're going to have people offer way over what the person is asking, and the people who win the house, win the bidding war, they're the ones that are saying, hey, I don't care what the bank appraises this house at. I want to buy it from you for $500,000. So if the bank only appraises it at $450,000, I don't care. I will pay the difference. And so yes, my mortgage will only be whatever the bank will give me, but I've got enough cash in the bank where I'm going to make up the difference. And this is simply a supply-demand issue that's going on right now. There are not enough people willing to sell their homes to meet the demand for all the people that want to buy homes right now. It's so crazy right now that in January, there were more real estate agents than homes for sale in the United States. Unbelievable. Now, pending homes, despite low inventory, pending home sales have actually been picking up. We're seeing more and more homes being sold, and that's simply due to the pace at which these homes are being sold as soon as they get onto the market. So we're seeing more actual transactions take place despite the fact that inventory is so low, and probably because of that. Now, if you're paying attention to the real estate market at all, that statement and this chart might actually make you wonder why you've seen another statistic which says that mortgage applications are plummeting. How can we have more home sales taking place than the last couple of years, while at the same time the total mortgage applications are plummeting? And that's simply because most mortgage applications that have gone through over the last year have been refinancing. Obviously, if somebody has a 4% or a 5% interest rate on their mortgage over the last year, when mortgage rates hit an all-time low, people are going to take advantage of that. And it was swamping mortgage companies all across the nation. They just could not keep up with the demand. Literally everybody who had a mortgage was trying to refinance because it's free money. Why not reduce your payment? If you can refinance your mortgage and get a lower payment and not have to leverage up your home anymore, not have to take out equity, not have to do anything, all you do is reduce your payment because the interest rate has gone down across the market. Why not? Now that interest rates are back on the rise, the refinancing portions of mortgage applications have begun to plummet. That's understandable. Interest rates are going back up. There's far less people out there now who currently have a mortgage with a higher interest rate than what you can get right now with a new mortgage. So refinancing isn't going to save them any money. And so it is not a concern at all that mortgage applications are plummeting because most of those were refinancing. We still have extremely healthy demand, especially considering the supply. Now, you're probably thinking at this point, the big reason, the big thing, the foreclosures, the forbearance crisis that we have right now. Crisis. You're probably thinking, hey, literally the only reason why we don't have enough supply in the market is because everybody's in forbearance right now. Nobody has to pay their mortgage. Nobody has any consequences for not paying their mortgage right now. It's just putting money in people's pockets. And as soon as that ends, nobody's going to be able to afford their mortgage anymore. We're going to have a foreclosure crisis sweep across the country, and a massive amount of supply is going to come onto the market. And if the current forbearance numbers were taking place in years prior to 2020, that argument would make a lot of sense. It just doesn't hold weight right now simply because there's really nothing somebody has to do in order to qualify for forbearance. All you have to do is contact your lender, usually just go on the website, click a few buttons, and you don't have to pay your mortgage for the next year or more. The data does not exist to look into the total forbearance numbers to determine how many of those people would not be able to pay their mortgage had that forbearance option not been there. Meaning that if forbearance ends, there's no way to tell at this moment how many of those people will not be able to pay their mortgage going forward. And the number of people who are most likely financially secure enough to continue to pay their mortgage is likely high enough that once this does end, there's not going to be any issue. Even if 25 or 30% of everybody who's in forbearance right now was to immediately go into foreclosure, have to sell their home, move somewhere else, start renting, get evicted, whatever, there are so many people looking to buy right now that yes, that would probably put that would definitely be a headwind. It would push a lot of downward pressure on home prices, but it's not near enough to cause a collapse, to cause a cataclysmic real estate crash. And now let's say, hypothetically, there are enough people that are currently in forbearance that won't be able to continue to pay their mortgage once that option ends. Which who knows how long that will continue to be extended for, because it's been extended multiple times now, so we'll see. What happens when the government gets involved in something? The government gets involved in something, they provide a subsidy because let's say they think it's slightly unaffordable. What's the next step that happens? Prices go up. We've seen it happen for decades in healthcare because healthcare has gotten more and more unaffordable, and so the government has gotten more and more involved and poured more and more money into it. What does that do? It jacks prices up. What about education? Education has gotten more and more unaffordable, and so the government over the last couple of decades has poured more and more and more money into education. What has that done? It's jacked the prices up. Quality hasn't increased, but if you look at the growth of administrators in healthcare and education, they've exploded. Because if you could afford it last year without a government subsidy, you got a government subsidy this year, you can afford what you were going to pay last year, plus whatever the subsidy is. It's an iron law of taxation and tax deductions that if you want something to grow, you need to subsidize it, and if you want something to decrease, you need to tax it. And what would you know? The same thing is happening to housing. Every time over the last couple of decades that home prices have gotten too far away from the average person, or especially from poor people, government steps in and says, hey, we need to make this more affordable. And how do they try and do that? They throw money at the problem with a dash of regulation to boot. What does that do? It drives prices up. And what great timing that big shout out to Meet Kevin for talking about this on his channel recently. The Bureau of Consumer Financial Protection has recently proposed a way to deal with a potential foreclosure crisis that might come out of the current forbearance. Basically saying, and this is not law yet, but this is what they're proposing to do in order to end the endless extensions of forbearance. They're basically saying that, hey, lenders will have to work with you in order to lower your payment to something that's affordable, offering to extend your mortgage up to 40 years from the current date. So let's say you're 1 year into your 30-year mortgage, you take this option, now you've got a 40-year mortgage from today in order to either keep your current payments or lower your current payments. Let's say you're 25 years into your mortgage and you take this option. Boom, now you've got a 40-year mortgage, which is the remainder of your loan left. That would drastically reduce your payments. Now, they're able to do this because the Federal Reserve buys so much mortgage debt. This wouldn't be possible if this was all done by the free market, because people have to worry about, profitability and the concerns of it getting paid back with dollars that are, worth at least the same as the ones that you loan, so the inflation doesn't erode your purchasing power, all of that. But the Federal Reserve can print money. They can buy as many of these as they want. Now, just in case you're concerned about this being a repeat, because, basically the only similarity to, 12 years ago is that housing prices have gone up a lot. It's not nothing like it was 12 years ago. There is widespread fear. Everybody's concerned. Many people are saying, hey, there's going to be a housing market crash. And we all know bulls climb a wall of worry. The supply and demand dynamics 12 years ago were exactly the opposite as they are today. Lending standards were zero. They basically were non-existent 12 years ago. Today, only the most creditworthy are getting their mortgage applications approved. Everybody has equity in their homes today versus 12 years ago, nobody did. Nobody has those adjustable rate mortgages like almost everybody did 12 years ago. And we don't have the same derivative problem specifically with mortgages that we did 12 years ago either. These things aren't being packaged up into packages with all the horrible mortgages thrown into one package with multiple levels of derivatives, all betting on that succeeding and then shoved into retirement accounts and spread throughout the investment banking world. It's nothing like that is happening. The bottom line is that people are looking around, and now, more than ever before, the average individual is aware of the fact that the Federal Reserve, our central bank, has printed trillions of dollars. These dollars are slowly getting injected, or in some cases very quickly getting injected into the economy, and they're driving up prices. People are looking at their receipts every time they leave the grocery store and realizing, hey, food is costing more. Hey, gas is costing more. Hey, when I go to Lowe's or Home Depot and I have to buy lumber is skyrocketing. Copper is skyrocketing. Obviously, we've been talking about housing is skyrocketing. For the average person, the average cost of living is going up far faster than 3 or 4% annually. And so if you can borrow money at 3 or 4% annually and pay that back over 30 years, what you're essentially doing is shorting the dollar. You're taking a position, you're buying an asset, and as inflation takes off, it becomes easier and easier to get your hands on new dollars, meaning that the dollars that you accumulate over the next 30 years, it becomes easier and easier to get your hands on those, and when you pay those back, they don't go as far as they did when you originally started the mortgage, meaning you're paying back debt with dollars that are worth less than what you originally borrowed. Said another way, when adjusted for inflation, mortgages are free money. And by the way, like I mentioned, raw materials prices are skyrocketing. What is a house other than a pile of raw materials plus labor that have been put together in a way that is more useful and more valuable than the sum of just their parts? And so the cost to develop new homes is continually increasing at a faster and faster pace as well, meaning that yes, we've got a lot of new development starting by home builders across the country, but at the current pace, it will take years to catch up with the demand. And if inflation continues to move at the current pace, the cost will still go up even if development increases, because development costs will increase as well. So bottom line, I am extremely bullish on real estate right now. Any potential headwinds, in my view, are nothing compared to the tailwinds that we have for the next 5 or 10 years minimum. And hypothetically, let's say we do have a real estate crash where prices plummet. If you've invested in real estate for cash flow, what do you care? If home prices collapse tomorrow, drop by 50% across the board tomorrow, everyone still needs a place to live. That means your rental property will still have tenants. That means if you've bought in an educated manner, in a good area, in a good neighborhood that, lower income, not buying like a mansion, I'm talking about, buying homes that are meant to be rental homes, everybody still needs a place to live. That means you're going to keep tenants. So I do not care what the value of my real estate is. I care about the cash flow. So in light of all of that, here are my top 2 ways that I like to invest in real estate. Number 1, roofstock.com. I really like this company, this business, this platform. They make it extremely easy to buy a home. Number 1, I'm not buying homes in places like San Francisco or New York City, right? I'm buying properties that are in places that are good rental markets, and roofstock.com has these. They have professionals on the phone that'll walk you through the entire process, especially for beginners. This is an absolutely fantastic resource. They'll connect you with every service and vendor that you need, all the way through setting you up with a property manager in the area where your property is. And then once the process is done, you own the home, the property manager does the work for you. They take some of your cash flow, they put a renter in it, they take care of the maintenance, and every once in a while you might have to answer an email or a phone call. Very low priced properties that cash flow extremely well all across the country. I love roofstock.com. But let's say that's too much work for you and you don't want to commit to actually buying properties. The second resource that I really like is Ground Floor. Ground Floor is basically a middleman for for real estate development debt. So let's say you've got some cash and you're looking at the S&P 500 and you're thinking, hey, I don't want to invest in stocks, but I don't want to go out and buy a property, but I want to earn some interest on my cash that, the bank's paying me 0.00001%. I want to earn some interest on this cash. You go to ground floor, you lend to a couple of these loans, and you get, 10, 9, 8, sometimes I've seen up to like 14.5% on loans. These are like 6 to 12 month loans. You can invest as little as $10 in each loan. So it's really easy to get started. They take everybody who's invested in one loan, they take that, they give that to one real estate investor who's going to take that. They're going to go develop a property. It's a 6 to 12 month loan. And then at the end of that, they're going to refinance that property, or they're going to sell it, do whatever they want. And then they're going to pay back that loan. And it's collateralized by the property, right? So very safe and a high interest way to invest in real estate without having the commitment of actually owning properties. And by the way, you can actually take the other side of that as well. If you see a property that fits the qualification that they loan for, you can go to them to get a loan as well. That way you don't have to mess with the banks. It's an extremely easy and friction-free way to invest in real estate development debt. I've got both of those resources linked in the description below for you. As always, I really appreciate you guys. Thanks so much for watching. Have a good day.